So you're thinking about getting into real estate investing, maybe in 2026? It can seem kind of intimidating, right? Well, today, we're going to break it all down. We're going to give you a step-by-step guide to start building your wealth through property. Let's dive in. Okay, so let's be real. A lot of us are looking for a solid, proven way to build wealth for the long haul, right? And time again, real estate comes up as one of the best answers. And we're not just talking about owning the house you live in. This is about owning a real, tangible asset, something you can touch that can actually put money in your pocket every single month and grow in value while you sleep. So you might be wondering, is now even a good time? Well, let's look at the numbers. As of late 2024, the average one-year return was a whopping 18.5%. Yeah, you heard that right. That number tells a story, It shows some incredible resilience and a really strong recovery in the market. What that's signaling is that 2026, it could be a fantastic time for new investors to jump in. All right, here's how we're going to tackle this today. First, we'll get into the secret sauce, the wealth formula. Then you'll figure out what kind of investor you are. We'll look at the active investor's playbook, get a little reality check, and then wrap it all up with a roadmap so you can take your very first step. Okay, first up, the wealth formula. So how does this whole thing actually work? How does a property turn into real wealth? Well, it's not some kind of magic trick. It really comes down to four powerful pillars that all work together. And here they are. These are the four engines that are going to power your investment. You've got cash flow, that's money from rent coming in. Appreciation, that's the property just getting more valuable over time. Leverage, which is a fancy way of saying you're using the bank's money. And finally, it's a great hedge against inflation. They're all super important, but let's kick things off with appreciation because that's where things can get really exciting really fast. So what is appreciation? Honestly, it's the simplest concept. It's your property making money for you pretty much without you having to lift a finger. As a neighborhood gets more popular or new businesses move in, or even just because of regular old inflation, the value of your property tends to go up. It's awesome. Okay, and this is where that other pillar, leverage, comes in and acts like a total superpower. Check this out. Let's say you buy a $300,000 house, but you only put down $60,000. Now, if that house appreciates by just 3% in 1 year, that's a $9,000 gain. But wait, you didn't make $9,000 on $300,000. You made $9,000 on your $60,000 investment. That's a 15% return on your cash. You're controlling a huge asset with just a little bit of your own money. That's what absolutely supercharges your returns. All right, next up, it's time to choose your own adventure. Every single investor has to make this choice. Are you going to be an active, hands-on person, or are you more of a passive, hands-off type? Think about it like this. Do you want a side hustle where you're the boss, you're calling the shots, maybe even getting your hands dirty? Or would you rather have an investment that just kind of works for you in the background, making you money while you focus on other things? There's no wrong answer, but your answer here really defines your entire path forward. And as you can see, each path has its own set of plays. Active folks are doing things like buying rentals or flipping houses. Passive investors are looking at stuff like REITs, which are kind of like stocks for real estate, or crowdfunding platforms. For today, though, we're going to zero in on two of the most popular active strategies out there. All right, for all you hands-on people out there, this is the classic showdown. It's the long game versus the short game. Building a rental portfolio for steady, long-term wealth, or flipping houses for that quick, big score. And this chart just lays it out so clearly. These two paths are for totally different people with totally different goals. I like to think of it this way. Buy and hold is a marathon. You're building wealth slowly, steadily, over years and years. Fix and flip, that's a flat-out sprint. It's high effort, it's high risk, but the reward can be a massive, quick payout. And when we say the payoff can be huge, we mean it. Look at that number. The average national ROI for a house flip in 2026 is projected to be almost 39%. Now, don't get me wrong, the risks are real. You could blow your budget, the market could slow down, but that potential for such a massive, rapid profit, well, that's what makes it so darn appealing to so many people. Okay, let's get real for a minute. Time for a reality check. Because listen, no investment is a sure thing, and real estate is definitely no exception. If you want to be successful, you have got to go in with your eyes wide open. You need to know the amazing parts, but you also need to know the not so amazing parts. So yeah, the pros are fantastic. You're building equity, getting that monthly income, and the tax benefits are a huge plus. But The cons are just as real. Your money is tied up, you can't just sell a house tomorrow, a new roof can cost a fortune, and let's be honest, dealing with tenants can be a headache. But the single biggest pitfall for new investors, it's probably not what you're thinking. And here it is. This is such a crucial piece of advice. So many new investors get stars in their eyes. They overestimate how much money they'll make and totally underestimate how much things are going to cost. It's this combo of being a little too optimistic and just having a bad budget that can absolutely torpedo a great investment before it even gets off the ground. You have to remember, it's not just the mortgage payment. You've got to plan for when the property is empty, for repairs, for all the little costs that add up. Okay, so you get the concepts. You've seen the different strategies. You understand the risks. The big question is, how do you actually start? Well, here's your roadmap. Seriously, following a structured plan like this is so key. It keeps you from making emotional, knee-jerk decisions. First, figure out what you want. Then, do your homework and learn your local market. Then, you get your financing in place. And last but not least, start small. Don't try to build an empire overnight. But of course, this all leads to the one question everybody, and I mean everybody, asks. Okay, but how much cash do I actually need to do this? And, this is what's so cool about real estate today. There are so many different ways to get in the game. Just look at this chart. There's a strategy here for pretty much every budget. You absolutely do not need $100,000 sitting in the bank to get started. You can start with passive stuff like REITs, or if you've got more time than money, you can look into things like wholesaling or partnerships. There's a door for everyone. And while you're out there looking at potential properties, here's a little trick, a quick rule of thumb that tons of investors use. It's called the 1% rule. Basically, if you're looking at a $200,000 house, you want to see if it can rent for at least 1% of that, so $2,000 a month. If it does, it passes the initial smell test. Now, it's not the end-all be-all, but it's a super useful first filter to weed out bad deals quickly. And you know what? It's not just beginners like us who are seeing this opportunity. The big players are too. We're talking about a projected 15% rise in global real estate investment. And get this, 82% of wealth managers are planning to put more money into real estate. And that's a huge sign. When you see the smart, big money moving in, it tells you there's a lot of confidence in the market, which is great for everyone involved. Whew, okay, we have covered a ton of ground. But if you're going to remember anything, let it be this. Real estate wealth is built on cash flow, appreciation, and leverage. You've got to pick a path, active or passive. Know the pros and cons inside and out. Remember, you can start with less money than you think. And above all, success comes from education, a realistic budget, and a clear plan. Because at the end of the day, there is no single best strategy. There's no magic bullet. The only thing that matters is finding the plan that is best for you, for your money, your schedule, your skills, and what you actually want out of life. What works for your neighbor or some guru online might be the completely wrong move for you. So we'll just leave you with this to think about. Looking at your own situation, your capital, your goals, which path are you going to explore first?